It's a new year. It's a new year, Cameron. It's a new year. You've got a chance here to not be such a Debbie Downer.
Well, not much has really changed.
I know. I know. I saw your note. And there's plenty to be worried about. So we saw you probably 2 weeks ago, and you've been right about the sort of just churning, the sickening trading range we've been in with a downward bias, I think you'd still say.
Yes, and we were looking for signs that we could be primed for some kind of relief rally like we had back in October or June. But if you look, we still aren't at that point where this market is so bad that it's good, where it's just incredibly washed out and set up for a big rally. So all the technical statistics that we look at, things like percentage of names above their 50-day moving average or 200-day moving average, they're just kind of in middling territory. So that means that in the very near term, we don't have the kind of setup for a big rally. And it means that really the eyes really will be focused on the pressure from both valuation, from higher interest rates, which are being driven by better growth statistics, and then on the earnings front, which we'll hear more from as we enter earnings season in the next couple of weeks.
So earlier we had a gentleman on from J.P. Morgan, says churning around first half of the year as the Fed stays tight and earnings are pressured by continuing inflation and margins. So we test the lows, get to at least 3,600, maybe lower, but by the end of the year we end up above 4,000, 4,200. Do you take issue with that? Or I mean, anything's possible. Is that a possibility for you?
I think that's very plausible. I think a lot of this rests at the feet of when we start actually seeing weaker data. Because for us to see a big rally from here, you really do need to see support by the Fed, a pivot to actual accommodation or being a little bit more easy in policy. And really the only thing that's going to get the Fed to be more supportive of this market is much weaker data. So if we continue to chug along where we see the labor market remain tight, even if inflation falls, the Fed really won't have those degrees of freedom to become more supportive of markets. So we do think that there is earnings pressure, but our idea is that actual lower inflation is bad for earnings because it creates less revenue growth, and lower revenue growth usually results in lower margins. And margins are still 100 basis points above where they were pre-pandemic. So in this world where growth stays okay, but we see less inflation, you actually could see earnings risk even without the U.S. economy slipping into a recession.
I ask everyone this too: is the leadership, if we ever do get to a point where, stocks are a buy, will the leadership be similar, different, similar in certain regards, different in other, or totally different? Will it be value versus growth, no tech, industrials? What do you think finally emerges as the leadership?
I think that that's such an important question because the world we live in today seems wildly different than the setup that we had going into the last cycle, which was all about quantitative easing, zero interest rate policy, and really a support for those growth names. And without that support from central banks around the world, we think this leans more towards value. And if you think about in today's world, even before we're trying to take the ultimate bottom, we do think that value is set up better than growth simply because of valuations. Growth still trades at a 60% premium to value. Usually in the last cycle, that was about a 10 to 40% premium. So there's still risk to growth valuations and even growth earnings, because growth companies were the ones that pulled forward the most earnings, pulled forward the most hiring into 2020 and 2021. So that's really where the reckoning comes in when we think about that growth versus value.